Welcome back to the channel, everyone. It's Nick Armenis here, and in today's video, I'm going to take you through my best ASX stocks for October 2021. Before we get into the content, guys, please make sure you subscribe, hit that notification bell, and give the video a thumbs up if you enjoy the content. It really helps the channel grow. As always, I'm not a financial professional, guys. These are just my opinions. It's a really good starting point just to do your own research. So as always, I cover off my theme of the month, and this month what appears to be the talk of all the news and I guess what's impacting stocks is inflation and supply chain issues. These are the two things that I see being potential headwinds for stocks and for companies and the economy more broadly. So what is going on? Many companies are continuing to see price increases in inputs, so in the things that they spend their money on to create whatever they create, especially due to shortages in labor, raw materials, and container prices. Obviously, as prices go up for businesses, they pass these on to consumers. But once you have such rapid increases, this can cause massive distortions in economies, which is not normally very good. High energy prices is another thing that's happening at the moment. So oil has spiked and natural gas has actually doubled in the last 2 odd weeks. Obviously, depending on when you watch this video, this might change. We've got huge supply chain disruptions, as I said, with shortages in things like containers, ships, truck drivers. These are all very complicated issues though, guys. So this is just more what I'm seeing. There's not necessarily always an action point because it's super technical. We just don't know. I mean, a shortage of containers might be bad for some businesses and then good for others. Other thing, obviously because of inflation and worries and things like that, the Bank of New Zealand has raised rates to attempt to control inflation. Now, New Zealand is a small economy, but there are some other bigger economies such as the Bank of England and the Chicago Fed that they see inflation staying around for longer than initially thought. So there was all this talk of it being transitory, so temporary, but it may be around for longer than we think. Now, I'm obviously not being a doom and gloomer, just something to note and something to make sure you keep an eye on. Obviously, you guys being boots on the ground, you'll be seeing this sort of stuff, with increases in prices of, products you buy, food, things like that. House prices definitely have been going through the roof. So there is some form of inflation occurring. Whether or not it's here to stay, who knows? I don't have a crystal ball. All of this may accelerate central banks tapering, guys. So that's the main reason I look at it, because higher rates is really going to hurt high PE stocks and also stocks that can't control their prices. So kind of what I would be focusing on, and I am focusing on at the moment, is I'm looking at, okay, have I got any high PE stocks that I've made a lot of gains in? Can I take some of this profit and then reinvest it into some new opportunities? Just something to consider. Obviously, everyone's situation is different. And then which stocks going forward are going to be able to control their prices? So with that, let's move into the companies that I like. So I'm looking for companies that can control costs, pass on price increases easily. So I'll first cover off my mid and large caps. First one is Woolworths, ASX ticker WOW. Obviously, everyone knows who Woolworths is if you're in Australia. They're a retail operator, obviously, of grocery stores in Australia and New Zealand with over 3,357 stores and approximately 215,000 employees. Its business division comprises of Australian Food, New Zealand Food, and Big W. So they're the 3 divisions. It's currently trading at $39 with a market cap of $49.62. As you can see, the stock has been on a really, really good run over the long term. And its 52-week trading range, though, not so impressive at $35.78, all the way up to $43.87. It's trading on a PE of 23.84, which historically is a little bit high for this stock. And it has a forward dividend yield of 2.8%. Now, why do I like Woolworths? Based on what I told you in the previous slides, they've got really, really strong pricing power, guys. If you want to do business with Woolworths, you're basically saying, they say we will not accept price increases. That's how they run their business. They do not accept price increases from suppliers, or very, very rarely, and they prefer to keep prices low so their consumers do well, in their words. But obviously, they do this because they want to maintain or improve margins because they're an ASX listed business. So if you're a business owner, that's great. If you're a supplier, probably not so good. They can actually quite effectively control its costs due to its size, huge bargaining power. If you lose a contract as big as Woolworths on something, then it's going to impact you greatly. So if they push back on costs, which they're able to do so, they can keep a lid on the, I guess, cost inflation. So in an inflationary environment, they will likely sell the exact same amount of product, but likely at higher prices, guys. And the fact of the matter is, a lot of their products are inelastic demand. So as food prices go up, you don't necessarily consume less of them, especially of those things that you have to have. So food products are obviously not that price sensitive, so we need to eat, and that's why they tend to do well in inflationary environments. Not necessarily that being the case, but even if it's transitory, they should still be able to post reasonable earnings because of this. The other interesting business, well, it's actually an ETF, is the VanEck Morningstar Wide Mode ETF, ASX ticker MOAT or MOAT. So MOAT gives investors exposures to a diversified portfolio of attractively priced US companies with a sustainable competitive advantages, according to Morningstar's equity research team. So a MOAT is basically some competitive advantage that's quite hard to overcome normally. So think of Coca-Cola's brand, for example, is probably the most commonly cited one. Apple's brand, big moat. Here are the sector weightings. So the reason I kind of like this, guys, is it gives you quite broad exposure. It's currently trading at $101.27. And as you can see, over the last 5-6 years, it's done quite well. And the 52-week trading range is 75.16 to 106.81. So it's kind of trading towards that 52-week high. My thesis on this one is pretty simple, guys. So we're highly diversified, low-cost ETF. We're not putting all our eggs in one basket, so we're not taking the risk of one particular stock doing poorly. And we're investing in businesses that have a wide moat, which means they're going to have strong brand loyalty, can control costs, they're going to be larger businesses normally, and can pass on price increases without a huge drop in demand. So as we know, earnings growth drives share prices. So if these guys can continue to drive earnings, keep the lid on costs, they should do reasonably well. Now let's look towards the more risky end of the spectrum in the small caps. First one is Aerometrex, I believe I'm saying that right, I'm not sure, Limited, ASX ticker AMX. So who are they? They're an established professional aerial mapping company with specialist expertise in aerial imaging, photogrammetry, however you say that, LiDAR, 3D modeling, and subscription services based on aerial imagery and web servicing. So guys, they're currently trading at 68 cents with a market cap of 64.19 million, obviously on the riskier end of the spectrum. It's currently trading near its 52-week low, and it has been as high as 144, obviously quite a high volatile stock. So definitely one not to put all your eggs in a basket, just something I'm starting to look at. And let me know what you think of this business in the comments below. Maybe you're invested in it, just let me know. Investment thesis, so they're expanding in the US with 3D modeling program that they have. And they've got some great customers like Google, for example. A big growth driver for them, which is probably the main reason I'm excited, is the virtual and augmented reality used for their products, VR, AR. So they're big focuses of businesses like Facebook, for example. And these guys provide the 3D data content which fuels this technology, because although Facebook has, I guess, the hardware and some of the software, the info, similar to machine learning, needs to be derived from somewhere. So these guys provide that. They can help in a wide range of industries. So I like that, because when you've got a product that can be replicated and used in other industries, obviously that helps because it costs you X amount to create the product. Then the more industries that are available to you, the more you can scale. So they can go into local government, insurance, engineering, and lots of other ones. So they're also investing in more staff and marketing to get their name out there, because obviously being a new business or smaller business as well, it does take money to get your name out there. The other key thing I liked was in their recent update, annual recurring revenue is really starting to rise, or ARR, so it was up 189%. So the reason I like that, more recurring revenue, easy it is for them to kind of forecast their business and keep it expanding. Next one is Redbubble ASX ticker RBL. So Redbubble, what do? They operate a global online marketplace connecting independent artists with customers. These marketplaces facilitate the sale and purchase of art and designs on a range of products between independent creatives and consumers. The products are produced and shipped by a third-party service provider. Every product on Redbubble's marketplaces is printed on demand. So they're not actually holding inventory, which is good, and made one at a time. The product does not exist unless and until the customer orders it, which means less waste. That would be partly true because they would have some amount of inventory there of a thing and then print it. So the printing would be done. The actual product is probably already being created and they would have to forecast that to an extent, I imagine. But overall, it's a win-win business model and it's fairly capital light because of that. It's currently trading at $4.36 and its 52-week trading range is $2.62 to $7.35. So it's kind of sitting in the middle there. The market cap is 1.21 billion. It's trading on a P of 38.58, and it does have a positive EPS, which is good to see. So it does have, I guess, a little bit more. It's not as high of a risk as the previous stock, but it is quite an exciting one in my view. And basically because they've got an interesting operating model, which I like. It's capital light, where they don't actually need to come up with designs or hold a lot of inventory. Consumers love custom and unique products. I myself am in the e-commerce marketing space, and I know that custom print-on-demand products are very, very popular, and this gives them access to it, right? And also allows artists a way to make some money too. Think Etsy, guys, with this product. Etsy has a $27 billion valuation versus a 1.2. I'm not saying this will become the next Etsy necessarily, but I'm just showing you that there is scope for them to grow, and it is a big market. So they had a really strong FY21 result with revenue growing 58% to 553 million, and they're aiming to lift that to 1.5 billion over the next few years. Huge addressable market. They're claiming it's around 330 billion. Obviously, take that with a grain of salt because the business is, of course, going to tell you it's huge. So I honestly don't know how big this market is, but I know that it's quite big and they're going to hit that, hopefully that 1.5 billion. And as I said, win-win business where artists, businesses, and customers get some form of a benefit. I really like these sort of businesses because everyone wins. The last one is Damstra Holdings Limited, ASX ticker DTC. What do they do? This is obviously a bit higher risk, guys. It's a provider of integrated workplace management solutions to multiple industry segments across the globe. Again, with this one, I'm kind of trying to find, again, could this be the next Xero? I'm not sold on it, but it may just be. So it may be something smaller, but still able to, if they're able to pull off some things, have some rapid growth. So company develops, sells, and implements integrated hardware and software as a service solutions in industries where compliance and safety are of utmost importance. So it's trading at 90 cents, guys, and its 52-week trading range is $75 to $2.44, so it is quite low in that range. It's got a market cap of 168 million. My investment thesis for this, guys, is COVID and environmental and other government regulation has increased demand for, managing remote contract-based workforces, particularly when you have high-risk workforces, think health, think mining. It's got a large addressable market. Think of how big the global workforce is, guys. So they're claiming it could be as big as $20 billion. It's got a high gross margin business, right? So it is a high gross margin business. So 79% gross margins are huge. That's why I like it, software business. Latest update showed strong growth across key metrics, guys, which was really good to see. And they've recently made a pretty substantial acquisition of a business called Tix, a workplace compliance business. So this further strengthens their offering, okay? So an interesting little business, definitely one I'm going to do a bit more digging into, but let me know in the comments below what you thought. And as always, guys, thank you so much for listening. I will see you in the next video. Please subscribe, hit that notification bell if you want to see my latest videos be released to you first, and give the video a thumbs up, and I will see you very shortly in the next video.